Janice Wood. Welcome to my Thursday morning show that talks about subjects that are interesting for senior citizens. Real quickly about me, I'm a Medicare insurance specialist. I do Medicare Advantage plans, supplemental plans, and prescription drug plans. But I'm not here today to talk about Medicare. I have a guest this morning, and his name is Justin Bithelll. He's a farmer's insurance agent. I'm really happy to have him on because my first experiences with insurance was with farmer's insurance. After I retired from working, became bored. I started out with my life license, and then I got a PNC license, and I was with farmers for about 18 months back in 2009. So I know what a good product they have. I know what a good, solid company they are. And I still have farmers insurance. Justin and I have become fast friends over the last year. And we get on the phone, we start talking, and an hour and a half is we still have lots to talk about.
This is true. Well, thank you for having me. Thank you for having me.
Thank you. So, Justin, tell us something about yourself.
Well, I have been in the financial planning industry for about 20 years now, in various roles. So I started off as an analyst on Wall Street, and then I became a financial planner. Eventually became a CFO of a manufacturing company, and then decided to transition back into dealing face to face with clients. And so I ended up buying a farmer's insurance agency.
Okay.
Yeah.
So when we talk about property and casualty, to most people, we're talking about something everybody has.
Yes.
An automobile, may it be.
Yeah, car, home.
It could be a truck, it could be a motorhome, a motorcycle, and of course, your home.
Mm-hmm.
A condominium, it could be even your space in an apartment building. We all need to have insurances. And of course, if you're like the majority of us, we have mortgages and we're required to have homeowners insurance. And there's so many other different types that fall under what type of insurance you offer. So let's start with automobile insurance.
Okay.
I know when I worked 36 years for a government, I won't say which one, okay? And I traveled 30 miles one way to work and 30 miles back, okay? So that's 60 miles a day. Sometimes I carpooled, sometimes I didn't. But what I needed for insurance for my automobile was different than what it is, well, at this present time. And I didn't need the same amount of things. And of course, I went through many different cars, and my need for the insurance, the property and casualty part of it was different. So tell us, what should we be looking for as seniors? And I know there's so many different scenarios to this subject.
Yeah, there definitely is, which is why you should, most people should be working with an advisor. A lot of times, when you're dealing with the call center, sometimes you're not even dealing with people in the United States where they really understand the culture very well, much less your individual needs. But there are a lot of different factors for seniors. But when you transition from working to retirement, typically the biggest one when it comes to auto insurance is you got to reduce your mileage, because it was one thing when you were commuting 5 days a week. It's another thing when you're going to the park down the street, or whatever it is you're doing.
Okay, so if I was like I was an office worker, so I had a sedentary type position, but but there's salespeople that are out there traveling.
Mm-hmm. Yeah.
Sometimes their companies may pay for that insurance, but sometimes they don't. There's construction workers. I mean, so there's all different scenarios out there. So
Yes.
how do you figure out what each person needs?
Well, I mean, you just have to talk to them and understand their questions, their answers to various questions. So obviously, if someone is an electrician, let's say, and they're going from job site to job site, maybe they're working out of their house, so there is no actual commute per se, but then they go to 10 different job sites in and around the county. Maybe they put on 100, 200 miles a day. Right. And then they have a business use risk. So they need a commercial auto insurance policy that's going to cover everything that they need it for. Whereas if you are, if you are winding down, if you're retired, if you are, maybe you still got another 10 years to go before you retire, but your commute is, you're a teacher that works down the street, your exposure is much different. And so every single insurance just needs to, you need to make sure that you're paying for what you get and getting what you pay for, because the last thing you want to do is have a claim and then find out, hey, I didn't have the right insurance and now I'm not covered.
Now, one of the things I always have people ask me, and I don't understand the answer. So I'll say to somebody, what kind of insurance do you have? And they'll say,
full coverage.
Full coverage. Okay. Okay. I don't understand what that means. So
yes.
Yeah, I mean, so when you're looking at your automobile insurance, when let's say you own a home, single family dwelling, or a condominium, are your needs going to be the same? And is that going to affect whatever full coverage means?
Full coverage, when people say full coverage, they typically mean auto insurance. And they're referring to having, in addition to the liability that the government requires you to have, comprehensive and collision coverage for the vehicle itself. Which is nice to have, if comprehensive would cover if your car got stolen, if your car caught fire, if you're parked in the garage and the garage collapsed in an earthquake on your car, things like that. So if one of those things happened, you'd like to have comprehensive insurance, obviously, but that, and collision is obviously if one car hits another car, or you hit a tree, or something like that, but you're driving the vehicle, you cause an accident, that's where collision would come in. Again, nice to have, but depending on the value of your vehicle, that may or may not even be necessary. It may be the value of your vehicle is less than your deductible, and it's not even worth having.
Okay. Let's talk about the deductible, okay? And the premium, and then go back to the property and casualty.
Okay. So premium means, what you're paying every single month, or 6 months or year, depending on how you pay for your insurance, to the insurance company. That's what they're getting in exchange for taking on all the risk if something were to go wrong. And then as far as a deductible, the first, if you have a covered claim, the first X amount of money, depending on what your deductible is, $500, $1,000, whatever it is, it would be out of pocket to you before the insurance company kicks in. So obviously the higher the deductible, the lower the premium. And then if it's something that is not covered, well then, I mean, the deductible is, technically infinite, right? So you want to have something that is as broad of coverage as possible to cover as much scenarios as possible. And in an ideal world, the lowest deductible, lowest premium, in a perfect scenario, but those do have an inverse relationship.
Okay, because I know even in my world of health insurance, especially I call it pre-65 health insurance, that deductible and that premium really makes a difference.
Oh, yes, yes,
Okay.
yes. Especially on health insurance. On property and casualty insurance, there's usually a sweet spot. So like with health insurance, it's very, very clear. The lower your deductible, the more you're paying. Whereas, I just quoted someone recently, actually yesterday. I quoted someone where they had a $2,500 deductible, and we quoted a $500 deductible, and the difference was like $3 a year. So it made no sense to have the $2,500 deductible in that case and take on the extra $2,000 in risk.
Now, if I'm a senior, and we talked about this, and you knew exactly what I was talking about the other day, okay? And I'm going from having an older car, because I come from one of those families that we drive our cars until they're almost ready to be shot.
Me too. Me too.
Yeah. So
just basically shot one. So I have a brand new one now.
So I have a brand new one. So you and I had talked in the past. You said, well, if I buy a brand new car, because of all the new safety features on the car, my insurance is going to be lower. But then I went back to you the other day and I said, well, how come my insurance is higher? And the first thing you said was, you bought a hybrid.
Yes, yes. And electric vehicles are even more so, especially like a Tesla. The insurance can be very, very expensive. And that's strictly due to the cost of repairs. If someone were to, if you were to have a claim, it's a lot more expensive to repair a Tesla or a hybrid vehicle than it is, a Honda Civic or something that's not a hybrid.
It's not a hybrid. So it's definitely a difference. Okay. So when I look at my automobile insurance, now I'm going to go back to the homeowners, because I know if you have it with the same company, you can get discounts.
Yes, bundling discounts, and every insurance company is a little different as far as that goes. Farmers in particular is definitely about bundling, and so the discounts are, very, very, very generous when it comes to bundling. Home and auto, umbrella. Farmers actually is the only company, as far as I know, that gives a discount if you get earthquake insurance through the California Earthquake Authority. So you can actually save money on your home and your auto by having earthquake insurance.
Earthquake insurance? Okay. All right. We need to talk. Earthquake insurance. Okay. All right. So what's my other thing is that from when I sold homeowners insurance and automobile insurance, going back to the automobile, we'll say something about you have 30, 20, say 20,000, 100,000, 1570.
Oh, you mean like the liability insurance, 15, 30, 50, yeah.
And if the more property you own, and the value
higher
of that property, should that figure be higher?
Yes, to a degree. There's a minimum by law that you have to insure in the state of California. That's $15,000 per person, $30,000 per accident, and $5,000 in property damage. That was a law that was written back in the 70s. And back in the 70s, that would actually cover a vehicle, and that would cover medical bills. Nowadays, you cause an accident and that person goes to the hospital, that car gets totaled, and you have $5,000 worth of property damage coverage and $15,000 per person. Well, that's a nice down payment, but now we're going to start taking your house, your savings accounts, things like that, to come up with the difference. So you always want to make sure that you have enough insurance to cover, for sure, your assets. But also, just as a general rule, I personally feel even if you don't have a huge amount of assets, you still need enough to cover, the medical bills and a car, because you don't want. I remember when I was a starving college student, I had 100,000 per person, 300,000 per accident, and 50,000 in property damage. So if I totaled a fancy car, I didn't have to worry about my wages getting garnished when I got out of college, to be able to pay for that car plus the interest on it, 4 years later or something like that. And so even if you don't have assets, you should still have enough where it's covering, it's covering at least a basic amount. And then if you do have assets, you want to make sure that your assets are protected should something really bad happen.
Okay. So what would you consider assets so people would know? Is that going to be the motorcycle?
That can be just a checking account, a savings account. That can be a motorcycle, an RV, a home, auto, a rental property, a boat, anything that they could go after.
Okay.
Your life, and if you have a whole life policy, that's pretty protected. If you have a retirement accounts, those are pretty protected. Pensions are pretty protected. But anything else is fair game if you don't have enough insurance and you cause damage.
Okay, so is it fair game also? Because a couple of weeks ago, I had David Gerson on talking about wills and trusts. So if you have property in a will and trust, or your assets in a will and trust, can they still go after it?
Well, David's a better person to ask on that question, but as far as that goes, if it's a living trust, they can go after it. If it's an irrevocable trust, they can't, because that's technically a separate entity entirely.
I never even thought of asking Dave that question, so that's a good subject.
That is a good subject for next time he's on. He could go on about that for quite a while. But if it's part of your assets, and now an irrevocable trust is extremely difficult to administer, because if you wrote something down wrong in that trust, you're bound by it. Because it's an irrevocable trust, it's a separate entity. It does not get to change its mind, and you are not it.
Right, but we don't want to. That's his expertise.
Right.
But I just wanted to see, because we're talking about the assets and can they go after it? So that's where I was trying to get with that.
Yeah. So it's typically better to insure it. It's going to be a lot cheaper, because you can always change your mind on insurance. You can always change depending on your needs of your insurance. You can't do that with an irrevocable trust.
Okay. So right now, what your expertise is, because we're getting into our time is going to start running out. Okay. So in your expertise is automobile insurance, anything that falls under automobile, car, SUV, a truck. You do commercial insurance also.
Yeah, commercial auto, commercial workers' comp, general liability. Those are all property and casualty insurances. Any type of business insurance, any type of individual's insurance.
So one of the things I would like to do is ask you to come back in about a month, and we'll build off of this, because we really didn't spend a lot of time with the homeowners insurance.
No, we barely even talked about it.
We barely talked about it. And you mentioned something about earthquake insurance and how that can lower some of your other premiums depending upon what it costs. And I'll talk to you about that personally, myself. Okay, because I don't have that.
Oh, really?
Yeah, I do not have earthquake insurance. And even in some areas, there's flood insurance, but I don't have that either. And I live on a river every so often.
Oh, really? You might want to consider that.
I have a big water channel behind. So now I'm going to show people how they can get in contact with either one of us.
Okay, wonderful.
Okay. So here it is. This is Justin's information right here. Justin Bithelll at farmersagent.com. And his phone number. So we'll leave this up for a couple of minutes. And this is how you get a hold of me. I'm going to make arrangements for Justin to come back in about a month because I know he's really busy. He's picked up some big apartment complexes lately.
Yeah.
Yeah. Okay. So, and we'll continue our conversation. This has been a lot of fun.
No, thank you for having me.
Yes, it's been great this morning. You refreshed my memory on insurance, on automobile insurance, on how some of that works. I appreciate it. And have a great day. And
You too.
oh, and by the way, Justin, I know, is going to the University of Farmers. I've been to the University of Farmers too. So it's not just a commercial. All right.
It isn't.
So
Yeah.
have a great day, and we'll talk with you. I know I'll talk with you very shortly.
All right,
Okay?
wonderful.
Okay.
All right, thank you.
Thank you.
Bye.
Bye.